The Federal Reserve just made its first rate cut in 4 years, so today let's talk about what rate cuts actually mean for our wallet. First, the rate they cut is called the Federal Funds Rate. Basically, this is the interest rate at which banks lend money to each other overnight. You might be wondering, wait, why would a bank need to borrow from another bank? Well, in real-world operations, sometimes banks run low on cash and need a quick loan to keep things moving. It's pretty normal. And this is where the Federal Reserve steps in. They oversee the interest rate for these kinds of transactions. Still confused? Let me break it down for you. Imagine a family with a bunch of kids. The parents give each kid $5 a week for pocket money. If one of the kids run out of cash, they can ask their sibling for a loan, but there's a limit. They can't borrow more than $5 from another kid. The parents are still in control of how much cash is floating around. The Federal Reserve is like those parents, but they don't care as much about the actual cash being passed around as they do about the rate it's being borrowed at. Now, the Fed has a bunch of tools they use to set this rate. Those are not super relevant to our conversation today, so I will just list a few major ones here if you are curious. What's important is, when the Fed sets the federal funds rate, it doesn't just affect banks. It becomes the benchmark for a lot of other interest rates across the economy. For example, if the federal funds rate is 5%, Bank A will lend to Bank B at that 5%. But if you are an individual trying to get a loan from Bank B, then they're probably going to charge you more than that, let's say 6%, because bank's gonna make some money too. Now, if the federal funds rate jumps to 10%, suddenly you are looking at taking out a loan with something like an 11% interest rate. See how that works? That's how the federal funds rate becomes the base for all kinds of loans. With that in mind, now let's talk about how this rate cut impacts our living costs. Most people are going to feel the influence of the rate cut from their mortgages and car loans. Right now, the average 30-year fixed mortgage rate for someone with an average credit score is about 6.9%. So if you took out a $300,000 mortgage, your monthly payment would be something around $1,976. But with a 0.5% rate cut, that mortgage rate drops to 6.4%. That takes your payments down to $1,877, and boom, you are saving $100 a month right away. And the Fed isn't done yet. They're talking about cutting another 0.5% later this year, another 1% for next year, and another 0.5% in 2026. If they hit all those cuts, we're gonna see mortgage rate drop to around 4.4%. For that same $300,000 mortgage, your monthly payment will shrink to $1,500. That's a serious cut. You're gonna save hundreds or even thousands each month depending on your loan size. If you can afford to wait, it might make sense to hold out for those lower rates, assuming inflation keeps cooling off. But if inflation kicks back up, all bets are off. The Fed might pump the brakes on rate cuts or even start hiking them again. Now, I know a lot of people are hoping that rate cuts will bring home prices or rent prices down, right? But here's the thing, lower interest rates don't guarantee cheaper houses. House prices are more about supply and demand. A lot of people who lock in super low mortgage rates during the pandemic, like 2% or 3%, aren't rushing to sell their homes. Why would they? If they sell now and need to buy a new place, they are looking at much higher mortgage rates. So if there are not enough sellers, there are not enough homes on the market, and with buyers competing for limited supply, house prices probably won't drop anytime soon. And rent prices work the same way. It's all about supply and demand. Fewer apartments available, more people needing a place to live, and boom, prices stay high. According to the latest CPI report, the shelter category went up 0.5% month over month and 5.2% year over year in August. Price growth is slowing down, but when will prices actually start to drop? That's still a big question mark. When it comes to the cost of everyday essentials like food and clothes, interest rates don't have as big an impact as they do on housing. These prices are largely driven by supply and demand too, but unlike housing, the supply and demand for food and clothing tend to be more stable. But looking at CPI data over the past 6 months, it's clear that price increases in food, apparel, and energy services have been relatively slow. However, when we shift focus to energy and transportation, we see far more volatility. Gas prices, for instance, fluctuated by as much as more than 6% month over month. This means you are likely seeing more consistency in your grocery bills, while energy and transportation costs are more unpredictable. However, the direct impact of rate cuts on these everyday expenses remains minimal, as they are still largely driven by supply and demand factors. Lower interest rates typically mean business owners are more likely to borrow money to expand their companies, and that's good news for job seekers, because more business expansion usually means more job opportunities. But right now, the job market is tricky. The Fed is closely watching market data to figure out when and how much to cut interest rates down the road. They don't want to cool the economy down too much, which could lead to high unemployment. On the flip side, they also don't want the job market to overheat because that could fuel inflation again. Basically, any unexpected swings in the job market could mess with Fed's rate cutting plan. So yeah, we're looking at some uncertainty in the job market over the next maybe 6 or 12 months. In short, home buyers are set to benefit the most from the current rate cut cycle, potentially saving them hundreds or even thousands of dollars each month. In the meanwhile, costs for essentials like food and apparel are expected to rise at a slower pace as the Fed aims to keep inflation rate low. However, both housing and job markets will need more time to establish a clear trend. That covers everything about how rate cuts impact our everyday spending and savings. If I missed anything or if you want to share your thoughts on the rate cuts, feel free to drop your comments below. And don't forget to hit that like button and subscribe. I'll see you next time.